to the Gatewood Wealth Solutions weekly market commentary broadcast. I'm John Gatewood, and with me today is our Chief Investment Officer, Aaron Tuttle. Welcome back, Aaron.
I'm glad to be here. How was your trip?
You know, my trip was fabulous. I was up in the Colorado Rocky Mountains above Silverthorne, and in fact, when we were coming back, it had the first snow on the mountains that very evening.
Wow.
Which is pretty cool.
How was your internet connection?
It was almost non-existent, so
All right.
that's why it was nice to get away, but it's also good to be back.
It was nice to get a lot of work done on Monday without your emails coming in.
I'm sure. Well, speaking of work, let's talk about how the economy is doing based upon the timeline that you've been talking about each week.
Yeah, so we continue to progress and climb out of that deep hole, at least whenever we're looking at the data. But last week we talked about our concern, especially with seeing some of the money supply growth drawback, that we may not be getting or maintaining that current growth rate. And the big concern, I think, is that we may see some stagflation if there is an additional stimulus or if we don't have that lockdown removed. We'll continue to watch it. A lot of the data is lagging. A lot of the data still is coming in, and it looks good isn't the right word, but promising, let's say, for that outcome.
Let's talk about the daily cases and the stats on the coronavirus. So those are the things that are really driving the government decisions on lockdown.
So we continue to see a decline, at least over the 7-day average in new daily cases. It has plateaued a little bit. We talked about in a couple of sessions ago, a couple of weeks ago, of these rural areas still needing to get their hotspots to kind of find their decline and get that susceptible base to drop so you don't have as much spreading. And I think that's still happening. That's why we see that plateau. There really isn't enough population in those areas to drive it up the way that it did. So I do expect to see a continual decline in the new daily cases.
Now, what about they had the universities where they had some people going back, and so people were thinking that there was going to be a dramatic increase. But I mean, there are some hot spots. So how do we account for that?
Yeah, there are some hot spots. But one of the things that we have to remember is, as more people have been exposed to the virus, there's a susceptible population, and this is a FARS model we're going back several months on whenever we were looking at how this would play out, and that we didn't expect 2.2 million deaths. We expected somewhere between 120,000, 200,000 deaths. And the more people that have had the virus, the more difficult it becomes to spread. And you will still have some hot spots from here, but it should continue to decline because there's less people that will be contagious with the virus. So we expect the new daily cases to continue to decline, but still seeing those resurgence of hotspots from time to time. Another positive, though, on the declining is that daily death count is trending down. It's been pretty flat. It's nowhere near the drop that we see on those new daily cases, but for the first time in a few weeks, we're below 1,000 deaths per day as a daily average. So it's good to see that decline happening.
Well, another point about the deaths is what you're going to show next is the information in the CDC about what cases or what percentage of cases were actually simply deaths by COVID versus
all
somebody
the
else that has
comorbidities.
Right. So maybe you can talk a little bit about
and we've
that.
talked about the risk categories, that if you didn't have some of these issues going in and you weren't in the older generation, that the risk for the virus was low. And if we go back to the very beginning, one of the big scares with this would be the Spanish flu, right, where we had 2.2 million deaths. Well, that never occurred. And whenever the CDC released the numbers showing the different age groups, the different comorbidities, we found that there was about 2.6 average comorbidities with the death. There were only 9,210 people that died from the virus alone. There wasn't other contributing factors. Now, the different sides that have taken a stance on the lockdown are both using these numbers in a way that I think is disingenuous. One side will say, well, there's only been a 6%, there's no pandemic, which is technically true, and we're looking at the Spanish flu, and that these are the only coronavirus deaths. All the other ones were the comorbidity. Well, that probably isn't true on the second part, because people that had heart disease or they had pneumonia may have made it through but it was that tipping point of the coronavirus. We have seen an increase in deaths because of the coronavirus, similar to the flu, actually a little bit higher than the flu. So both are using the data in a way that's favorable to their argument. But we certainly can see the risk factors there.
Yeah, well, the government lockdowns are really based upon protecting the whole population, but when you look at the data, it would seem to indicate that the focus should be on people that are at risk, which are the elderly and those that have, some type of other health factor. In fact, I know that, now we have probably a political move, but the Justice Department is suing several states because of the way that they put COVID patients in the nursing home or long-term care facilities. But that's more politicized, but at the beginning of the whole pandemic, they were just trying to do what they thought was best at the time without really understanding what the impact of moving patients there would be.
The Department of Justice has sent letters to the governors of New York, New Jersey, Michigan, and Pennsylvania. To your point, that is very much, the governors pushed back and said this is political. The only thing they're asking is for information. The old adage, you show me the man, I'll find the law they broke, right? So I think the governors are right to push back on this. But at the same time, I think we do need to have one of those blue remedy panels to try to figure out what happened, what should we do, what can we learn for future, and if with some grace, really, for the governors operating in an environment that they had not done, but also let's look and see were there actual nefarious mistakes, probably very little, but I think it's warranted to have that, but I do believe that this is more politically motivated. I don't think it's coincidence that it came out on the week of the Republican National Convention.
Well, let's talk about the Republican National Convention. Last week we were talking about that the Democratic National Convention had all the stats out in terms of the lift and...
Right, they went first.
And then you have the Republican National Convention. So we're now starting to get that information. So what impact did that have on voter choice and positioning of the two candidates and what we see might happen in terms of the market?
Right. Both conventions are hoping to have that post-convention bump. And depending on how the headlines are written, can actually encourage a specific party to be perceived as the winner and then get that momentum, right? And we were paying attention to see what was the result out of the convention. Well, whenever we look at campaign contributions, Republicans, I think they used the word raked in $76 million. That's certainly a large number and larger than the Democrats, but the Democrats brought in $70 million. It's not that big of a difference, but the advantage would go to the Republicans on campaign contributions. If we look at the Nielsen ratings, so how many people tuned in to the keynote speaker, right? So Biden had 24.6 million viewers watching his speech based on Nielsen ratings, while Trump had 23.8 million viewers watching his. Now, there were also some political movements going on and things that was criticized on the coverage of the RNC, where the RNC was going to have fact checkers going about and having a delay so that they could get in there and turn or spin different statements, whether right or wrong, that were not done to the DNC. And because of that, we believe a lot of people decided to tune in online through C-SPAN. C-SPAN said they had 6 times the viewership for the RNC versus the DNC. So then these are the numbers from the RNC, so take them for what they are, right?
There's always a way to show the facts in a way that is not quite the way it is.
There's lies, there's damn lies, and there's statistics, right? So online TV viewers, 147.9 million viewers in total for the DNC at 120 million viewers. Another thing is the Republican National Convention actually it went second, so people would be more aware because the DNC had already kind of brought that to attention, and the RNC had the opportunity of seeing how should they set the format up. So
what does the spread look like now between Biden and Trump?
So despite the numbers being provided, I think the numbers indicate, whenever we look at the battleground states on polling or we look at the betting odds, it does look like the RNC did gain, and they were the winner, quote unquote, out of the convention. They had the winning, the bump out of the convention. We can see over here on the left, the polls. Biden has started to slow some momentum and lose, and Trump has certainly appreciated. Now, there's other factors. There are the law and order strategy, where the Republicans are trying to put the protests and the riots specifically at the feet of the Democrats, and we're seeing Biden come out and try to position himself as well as a law and order candidate. But then when we look at the betting odds, this is actually from a couple of days ago. The betting odds now have President Trump as the favor at the moment to win re-election. Now, we don't put too much stock in these. We think they're good for trying to pick up general trends. But 2016, Brexit, all of that indicates that you can't make any investment decisions. You can't consider this a foregone conclusion. The polls are just not as accurate as they once were.
And there's a lot of time between now and when the election
There is an
actually
eternity
happens.
when it comes to
But
politics.
it is interesting to see how the media can communicate facts that make things look so much better or worse than what they actually are.
So there's always the gaming of headlines, and I think this is an example where Rasmussen had a poll. It was it came through CNS News, a pro-life. Obviously, that means it leans very right. A news outlet that said majority of blacks and other minority voters approve of Trump, topping whites' approval. So historically, blacks have voted 90% for Democrats. It's more 50-50 for whites. So I think it makes you stand up and take pause whenever you see something like this, that the black voters are now having a higher approval rating than white voters. That didn't stop Trump from declaring a victory there with his tweet, but I think Rasmussen, the ultimate source of the poll, did their own fact check, where they're saying, this is true, but it's one single one. So,
well, Rasmussen was the poll that we referred to last week.
It,
where they had
it was.
Way over the 50% mark.
On the approval rating, absolutely. And then here's another example of how the headlines can be gamed. So 6 Democrat mayors in Minnesota endorsed Trump for re-election. That certainly sounds very concerning for Democrats, and as if there's this massive movement. It is true that 6 Democrats mayors did endorse Trump, but let's look at the location. These are not mayors of large urban centers. They're over here in what's known as the Iron Range.
Right, and the number of voters that actually represents as a percentage of the total state is very small.
Very small. Blue collar, they typically are union workers. They have likely benefited from the more protectionist policies put in by the current administration. So I think what's happening is the different tents, Republican Party and Democrat Party, all made up of different factions, different interest groups. They are changing, and it's really starting to divide themselves more along rural voters versus urban voters. So I don't think it's a surprise to see some of these blue dog Democrats that were more of that union, blue-collar individuals that were in the Democratic Party that supported gun rights and found this important are beginning to shift to Republicans. So there's just a mix-up and a change with the different factions in the party, and I think this is what it's capturing, not so much that the Democrats are leaving the Republican Party in droves in the urban centers.
So how is the economy doing since last time we spoke?
So we continue to move up. The slope, or the amount of growth that we're seeing out of that deep hole, is certainly slowed, but we are currently at a growth rate of 15.27%. So we continue to climb out of that hole, but there has certainly been a slowdown that we've seen. John, one of the things that we've been talking about is that move from urban centers to suburban and rural, and we can see that here. We can talk about the different polls or whatever, but I think prices really tell you what's actually going on, or it's less biased, it's just better data. And we can see that Idaho, Maine, Arizona, Missouri, these are all areas where the home prices are increasing at a rate that's greater than the national average. What isn't
Missouri? How about that? Huh?
Missouri is one of them. I'm sure it's rural because St. Louis is actually one of the fastest shrinking cities.
Right.
Whenever we saw some of the data. And then you can see New York, Illinois, those are the ones that are growing at the slower pace. And then it's not on this slide, it became too busy, but when we look at rents, we can see Fort Lauderdale is up 5-6%, while New York, San Francisco, they're down 15-16% on single unit apartments. And then historically, for prices, at least on rents, they've actually declined during a recession. Other than these areas, if we look at the national average, that hasn't been the case. So we're definitely in a unique recession whenever we're looking at the data.
So one of the risks that we continue to bring up each week is the inflation risk. And then last week, you started to talk about this slide, which is Morgan Stanley's, or Morgan Stanley's, yeah, 4Ds. So
yes.
Let's talk more about that.
Sure. So the idea is that we think there are 4 trends, and we thought the Ds really captured that. And that is that demographics. The baby boomers, John, we're trying to get you to retire. You won't listen. You just continue to show up.
You get cantankerous.
Well, you don't have to do much, so why wouldn't you keep showing up, right? You've just retired here. But the consumption should go down, right? They're past family formation years. They have most of their possessions that they really need. So their consumption does drop. But at the same time, entitlements, Medicare, Social Security, which we are no longer funding out of the payroll tax, is creating deficits. So we would say the baby boomers retiring is actually a net neutral. Now, this is an oversimplification, right? But we think that that's net neutral for an inflationary trend. However, the millennials, the oldest, just starting to approach age 40, some of which are already in family formation mode, they're going to increase the consumption. The millennials are actually a bigger demographic group than the baby boomers at this time. So they're going to add a lot to that consumption. And with the baby boomers retiring, that is making room for them to get promotions. So they are seeing increases in their pay. And I think part of that home price increase, certainly other factors, but one would be that millennials are starting to buy houses, buy larger houses, build houses. So that, I think, is an inflationary trend. So if we just look at demographics, where baby boomers are neutral and it's positive on consumption for millennials, that's an inflationary trend within that category.
Then you have this deglobalization, because with globalization we were seeing deflation.
Right.
So if we're reversing that trend, now what?
That would be inflation, especially with the coronavirus. It's only accelerating, right? So we had supply chains that were onshoring. Well, that means that we have to build additional factories. A lot of the labor in the U.S. is more expensive, so the way that you reduce labor costs per product is add in a lot of capital investment or automation. So that requires different types of commodities, whether that's concrete, lumber, chips, all kinds of things that we think are really investments, and that investment component is going to increase as we onshore. And the companies that are going to benefit are the small cap, mid cap companies, those smaller companies. They're not the behemoths like Google, but we think they're going to grow. And we can see that back on that Iron Range example, right? They are seeing progress in their neighborhoods because there is manufacturing that is starting to come back to the United States. But that's not just free and a gimme. There is going to be some cost to that, and we see the cost as higher consumer product prices. One, it's a little bit more expensive to manufacture here, even with automation, but then you have to have all that concrete and other components that are going to be competing for.
Right, so you have the benefit of wages coming here, wages going up, but then that leads to the price increase.
Price increase, right, to pay for it.
So what about the deficits?
That's right, so that's another inflation. I think it's no mystery or surprise that we've had a lot of deficit spending, especially since 2008. But then the coronavirus was at a magnitude much greater than 2008, and these fiscal stimulus plans really, unlike 2008, are direct cash payments to consumers. So consumption here would increase because of this fiscal stimulus, and then we haven't seen inflation to this point. We have this growing modern monetary theory to add a universal basic income, so basically making fiscal stimulus checks is just the norm. All of that would be inflationary. So that's another trend that we see that is an inflationary trend.
So all those dollars coming in leads to that dollar debasement. So talk about that.
Right. So one is the dollar, where we have what is known as a mercantilist policy, right? By increasing the amount of dollars, whether it's a stated purpose or not, that makes products made in the U.S. cheaper relative to other countries, and makes other countries' products more expensive in the U.S., so that would decrease the value of the dollar. Some are actually concerned about the risk of losing the currency as the reserve currency of the world. We think that that's not likely to happen here in the near to medium term, but it's certainly a concern, as well as the keeping interest rates low through the Fed directly interjecting into the markets, buying securities. So these are all the four trends that we see that are really having an impact on inflation.
Right. So here's your descriptive tool that you were showing last week or a few weeks ago to describe what's happening.
Yeah, the model on how the economy works and the production component. So we can see consumption through millennial and direct stimulus payments to consumers going up. So there is higher consumption. We see investment going up with those small and mid-cap companies and the infrastructure necessary to bring that manufacturing process back to the U.S. So that's increasing. We see the money supply increasing because of the Federal Reserve's actions to both help with those fiscal payments, entitlements and Social Security and payments for the baby boomers, and just trying to meet the market or put support underneath the market as they buy securities, all of which is a recipe that we had talked about creating inflation. But at the same time, at least short term, so maybe this isn't a long-term trend, we have the economy producing less because of the lockdowns and the inconveniences those are putting on the manufacturing process. I think anyone that's ordering Amazon has noticed that there is a longer delay of just trying to get items. So we can see that all of these trends, based on the model, should all increase the likeliness that inflation will show back up.
So while we have this inflation risk, there's also a huge deflationary pressure that we've been going through for the last 20 years. So maybe you can talk more about that.
Right, the information age that we're living in, that we talk, many people are probably familiar with Moore's Law on the ability to pack in more transistors on a chip. And really what this means is that our knowledge has been doubling almost every 2 years, and this has been growing at an exponential rate. And the more we become a knowledge economy, the more we become dependent upon technology, the more the production of the overall economy is going to reflect that Moore's Law. So let's kind of get into an example, right?
So that looks like my computer. Almost, in fact, it might be a little bit even more complicated, complex than the first one I bought.
Well, it's probably more reliable than the current one.
The current one is the one that you carry in your hand.
That's true.
More.
Absolutely.
But you'll get into that.
But the idea here is that technology is deflationary. That whenever we think about progress in the economy, the natural order is to actually see prices decrease. And we can see that trend in computers, right? This computer was probably as much as $5,000 or $6,000 at the time. In today's dollars, I don't know what the exact price was then, but it was a very, very expensive computer, and it was not very capable. But what has happened is the price in real dollars, we can see that a computer actually costs less in just nominal dollars than it did 10 years ago, 20 years ago, and it's far more powerful. Think about what we're doing here, where we're doing a broadcast, all brought to us with the capabilities of having a broadcast that we just couldn't have done 10 years ago.
Well,
right?
Look at the Tesla picture that you have up there.
Right.
That's really a computer on wheels.
That's exactly right. So what happens whenever we've seen these huge deflationary trends, despite all the inflation that has been created by expanding the money supply, where computer prices have continued to go down, and we now have computers that are really just they're cars, like you said, a computer with wheels. And what impact is that going to have? And I think many people have probably seen this before. It's a very fun thought process or image that you see is the Radio Shack ad. And if we look at this Radio Shack, you probably have a mediocre computer here at $1,600 in dollars in the late 90s, maybe the early 2000s. And then look at all the technology that is on there. Well, everything in this ad is now done by that computer or that phone, and the phone does it at a much better rate. And there's plenty of more features that are not on this ad that phone can do. Well, what happened to all those industries? No one is making tape recorders or CD players or individual phones, at least not the way that they were, no camcorders. All those industries are gone.
They're all going into the iPhone.
And
or just
all the
smartphone.
other companies, all the sales companies, the Radio Shack, being able to sell it, all of that was replaced. Now, it wasn't the end of the world, but we can see if that starts to happen with vehicles and other things as they become more and more technology driven, more about the knowledge and information economy, are we going to see similar trends where, well, how big and complicated is a supply chain whenever the computer of that car isn't dependent upon engines anymore, it's a motor, and all the updates or enhancements to the car are basically software updates. It becomes more and more like a technology component, which has been very deflationary.
If I can kind of summarize what you're saying, is that the advances in technology have been remarkable, but the effect that they've had in the economy is actually keeps prices low.
Yes.
It's been deflationary. But we still see inflation as the biggest risk. So how can we see this in relation to the inflation?
So at first, the policies that we're doing to fight this deflationary trend are inflation. And we do see that. Remember, it's a boom-bust cycle. And we believe we're in the boom phase. So as the central banks continue to try to fight this deflationary trend, which they barely kept inflation positive through this time period, they've had to create a massive amount of debt to try to expand the money supply. We're now at near $27 trillion. We're expected to be at $40 trillion at this current level by the next election. And at some point, that debt, which is inflationary at the moment, becomes deflationary. It has to be paid back at some point. Now, yes, you can continue to issue debt, but then you're just continuing that problem.
At some point, that policy is going to fail. But in fact, it was interesting. Today, the Wall Street Journal reported that the amount of debt, the total amount of debt is going to be the size of the economy. It's going to exceed the size of the economy next year.
1 second. I think
we're having a little technical difficulty right now, but
Is that better?
We'll fix this in just a second.
That's better. Okay. So,
yes. So the debt is projected to be larger than the economy next year. Now we think that it's actually already surpassed that.
We look up here.
But the last time that happened was back in World War II. I mean, and even from just some historical perspective, when Ronald Reagan came into office, do you know what the amount of federal debt was at that point?
It wasn't 27 trillion?
It wasn't 27 trillion. It was only 800 billion. And he was talking about how do we keep from surpassing that number. But he ended up increasing the debt himself.
Yes, he did.
In fact, every president has ever since.
And at some point, higher taxes need to come about to try to pay some of this debt back or try to pay it down, which ultimately would also be deflationary. So when we hit that point, and we think we're probably a decade out, I think that we're going to have a major disruption, possibly depression, in the overall economy.
Well, this is why we're bringing this up over and over again, because we are concerned, as part of our mission is to help our clients not just become financially self-reliant, but to remain there.
Right.
So the flip side of this is that when the inflation goes, or the deficits get so high, they're going to have to be paid back, or they're going to file for bankruptcy and not pay back bondholders, which means that you're going to have asset prices declining.
Right.
And it's going to happen very rapidly because it's such a large system of debt that's been put out there.
Right, and you will either lose faith in the currency, and then you would have inflation because people are just trying to get rid of the currency, or there's going to be some type of bankruptcy where the debt just is removed, which that's how we increase the money supply so that you would have that deflationary trend. So this is showing that the boom is always followed by a bust at some point. There's no way to tell exactly when that time is, but we do believe here at Gatewood Wealth Solutions that at some point there is a reckoning, and it's likely to be a lot of financial pain if you have not been preparing for it.
Yeah, well, the important thing is that there are ways to prepare for that, and that's one of the things that we do in both our investment management and in the financial planning aspect of people's wealth.
And just so we're not too doom and gloom and making it so scary, a depression in the 2030s versus a depression in the 1930s is going to be a lot different because of that technology, right?
Correct.
You're probably going to be struggling with your robot maids, keeping the house. Your great grandparents who went through the depression will think you're in a marvelous environment, right?
Right. It's going to look a lot different.
Right. But we still won't be happy with it relative to what we had been experiencing. So John,
So let's talk about our cash targets. I know that we were talking about this last week because the market is at new highs.
Right.
And we're still in kind of uncertain times. Talk to us again about why we're recommending 36 months and to whom are we recommending that?
So we are at new all-time highs, and when we look at the performance of the portfolios, they've been at all-time highs for quite some time. The portfolios have really benefited through this. There has been some great selection, and we were at some point lucky, and we were making sure that we're setting some of that aside for those people that would need to get to their account or liquidate investments in the next, let's say, 24 to 36 months. So this allows those that have enough capital set aside and remain in the market that they could have 36 months or really get through not only this election but the following election before they would ever need to touch the corpus of that investment portfolio. So considering where we are, considering the risks that are there, we decided that for those that may need money in the near term, let's go ahead and raise additional cash. In addition, we've also taken a lot of risk out of the portfolio. I wouldn't say we're defensive. We were aggressive coming out of the March low, and we had bought convertibles. And the way that a convertible works is it's a bond that has the ability to convert to equity. And during that market crash, it's basically a bond because no one thinks it's going to appreciate to the point where they would be able to convert it to equities.
Talk to us about what we're favoring now.
Inflation risk, I think we've explained why we think that risk is high, and we're just saying that it's high, that there's no certainty here. There still is that deflationary trend that has been really a secular trend for the last 20 years. And then we still favor equities over fixed income at the moment, especially considering how low interest rates are. We favor U.S. domestic, going back to that iron range example, as small companies, mid-cap companies are able to benefit from a cheaper dollar. And then we favor technology because we think technology is the big growth area that has been causing that deflationary movement and have been doing well. We are bearish on commodities in this slide, but we are actually starting to reconsider it as we see lumber prices go to all-time highs. Well, there's actually been shortages in some location for concrete. Agricultural goods are going up. So we're starting to see some commodities move up. We can go to that in a couple of slides away, but we were surprised by where commodities have risen over the last week. And then we talked about early on that residential move from large urban centers. We certainly are seeing that for sure. So those are our themes. Other than the commodities, I think we're still, there's no change here. I think we're just trying to explain why we have these positions. Hopefully we've done a good job on that today on the inflation standpoint.
So the S&P 500 now has reached another high.
Yes.
So.
And we do think there's going to be some slowdown on the appreciation. We're due for some type of minor pullback in the S&P, so wouldn't be surprised to see some volatility come back. And we actually expect volatility in a schizophrenic market for quite some time. We'll continue to be defensive. We'll continue to watch our technicals to try to do our best to mitigate those risks in portfolio while still making sure that clients can get the returns that they need for their long-term planning.
So where's the dollar now? Because I know that's something that we've been watching closely as well.
Yes, so the dollar has been struggling. It is weak. It actually, the euro had gained a little, or lost a little bit today, which means the dollar strengthened, which is what caused gold to sell off today in the markets. But this is concerning. The dollar has been losing to a basket of currencies. But when you start really drilling down to the math, it's mainly the yen and the euro. So we think it's starting to get a little bit oversold and a little too bullish on the euro and yen. Wouldn't be surprised to see some type of reversion here before we make any new lows. But there is certainly concern about dollar debasement that we talked about. And the current administration, I believe, wants a weaker dollar because it would benefit manufacturing returning to the U.S. At the expense of higher prices.
So let's talk about some of the questions that we've gotten from clients. So one of the questions is, if, assuming that Biden and Harris win, what would do well in the market, and how would we view our portfolios in that case?
Well, traditionally, if Democrats were to take power, win the Senate, win the House, or even just gain power, you like to go to health care. But if we had that blue wave, I think the Democrat Party, where they have both the Senate and the House, and they were to have the presidency, would likely move to a universal health care proposal. And the health sector probably wouldn't be the place to be at that point if it's going to go to a public option. So what we would do is just really pay attention to the technicals to see what the market's doing. There was an interesting study that we were looking at. It's not statistically significant just because you don't have enough data, but markets trend up the last 3 months coming up to an election if an incumbent party will remain in power. They trend down if there is a change. But the interesting part is once you have the election, both of them trend up, and they trend up by the same amount.
So it sounds like the Trump administration wants the market to go up because that would give him a better odds of winning. At least
I think
statistically, or is it the opposite?
You got the cart in front of the horses. Yes, he wants that because a sell-off in the market probably would jeopardize his reelection. But it's that his reelection likeliness would cause the market to move up because there's more certainty around the current structure of the economy, and there wouldn't be a need to make a change. If it looked like he was not going to have re-election, then you would assume that the policies are going to change, so there would be a reshuffling of how assets are allocated. So I don't think it's necessarily cause and effect, but it certainly has a 90% predictability. But once again, the data, there's just not enough data to say that it's statistically significant.
So I know that we're moving away from globalization. There's some of this move towards deglobalization. But then when you have the dollar declining relative to foreign currency, wouldn't that be an argument in favor of doing international investing?
It can be. One, I think the European Union is pretty much a mess because of the way that they've structured their economy. You would have some tailwinds for the currency, but this is one of the reasons that we've liked small cap and mid cap, is we do think that they would benefit from a weaker dollar. So there's other ways to play it other than just getting assets denominated in another currency. The small companies, the mid cap companies that would manufacture and their products would be more attractive outside the U.S. could also be a way to gain from a weaker dollar. We always will pay attention to our technicals because really what that's telling us is where money is going, what's performing well, and we would make changes based on that. But I don't think that your only option to benefit from a weak dollar is being outside of the dollar. There are ways to remain in the U.S. dollar and benefit as well.
You know, I mean, while the numbers or the data is showing improvements in the economy, there's still a lot of negative news out there. For example, unemployment. You know,
yes.
So we've had a lot of companies, the larger companies, had kept on employees, but now the PPP is running out. the furloughed employees are now becoming fired employees. You have large, the airlines, for example, are announcing very massive layoffs.
Absolutely.
And so, is this going to impact the market? I mean, because we're looking at market highs with all this negative news coming out. How do we figure all that stuff out?
So there's always the, all else equal, yes, but not all things are equal. There are unemployment problems, and one of the things that we've talked about often is this recession is more like a natural disaster, but if we go too long with the lockdown and the shutdowns, the artificial cramping down on the economy, it can turn into an actual recession that's like a business cycle downturn. I think we're getting that going too far at this point, and that uncertainty. Like it used to be that we would have some different phases. After the 14-day average would decrease, you could go to the next phase. All of that is no longer guidelines that business owners can look at, and that's creating uncertainty, and we are seeing companies lay off. We should see much higher employment numbers each week where we are in the economy, and we're just not seeing that. So we think the likely outcome is stagflation. Because we have created a lot of money, it is going. There are companies that are actually becoming more profitable as they lay people off, so their earnings are growing. So you're seeing a market appreciate. Production capacity in some of the other industries is dropping. So we see the risk of stagflation as being very real, meaning if you want to be defensive because the economy is struggling, you don't want to go to dollars because inflation is hurting those dollars. You want to find areas that are doing well. It's one of the reasons our portfolios have done so well is because we have been in those areas which are technology and have been better able to deal with it. In addition,
last time we had that stagflation was back in the 70s.
Yes.
So we had high unemployment during the oil crisis, and we had rising inflation.
In addition, there are new jobs that are coming on the market. So we do have travel and entertainment laying people off. But at the same time, you have people that are delivering groceries. It used to be, if you would have told somebody 20 years ago, I'm going to have my groceries delivered to me each week, they would have thought, wow, you must really be a very, very wealthy person. How could you ever afford that? Well, the average household is now having their groceries delivered, and that means new employment in those areas as they move to that gig economy and that Uber type of business model, but now being applied to groceries or going to the store, etc. So there are new jobs being created at the same time.
So one of the things that we'll cover more on as these broadcasts continue is our long-term view that we're on an unsustainable path, and there is an organization or a think tank that we subscribe to called the Institute for Trend Research, and they've been forecasting a global depression in 2030. Now, again, this is not to alarm people, it's just to understand that the economics are going to change because of the various things that you were talking about with the 4 Ds. But what will be the signs that we'll be looking for as we get to that point?
I think the big sign that we watch often is just the money supply. And if that money supply begins to drop, that deflationary trend is going to kick in. They've expanded the money supply dramatically, yet we haven't seen the CPI really move much. So if the money supply starts to slow or starts to shrink, those deflationary forces are going to take over. And the way that we were trying to solve that is increasing the amount of debt. Well, that's why a lot of economists fear deflation so much, is trying to repay back debt, and that could bring that could unravel it. Or the inflation could actually heat up, and the central banks are trying to stop it by letting interest rates move up, which again is them actually decreasing the money supply. So we think for a long secular downward trend, we would see that in the money supply first. In addition, we're going to be looking at our technicals to just try to see what the trend is within the overall economy.
I mean, could this next decade that we're going into right now be kind of like the Roaring '20s?
Yes, absolutely. I think it is like the Roaring '20s.
So explain how that view works.
Okay, so I'm sorry if this is wonky.
It's always wonky.
So in the 1920s, you had the CPI developed by Fisher, which said you can control the money supply because the whole point is to make sure a basket of consumer prices is not moving up. But like the 20s, as we are today, there was the Industrial Revolution, the mechanization, you had cars that allowed you to travel, you had radios that sped up communication, you had, all of a sudden had all these home appliances, vacuums, etc. Amazing change.
Amount of productivity improvement.
So you didn't see the inflation in the basket of goods. So it allowed the Fed, the central bank, to continue to expand the money supply throughout the 20s, and that's why we had the Roaring '20s. At some point, though, you start to see the inflation, and the central banks did start to slow the money supply growth, and we had the crash. And then the Depression was likely made great because of the response by the government, Hoover administration first, followed by FDR, where they started to put in controls on wages. They didn't let the market clear itself. So then that made a very serious depression into what is likely the Great Depression. And I see the same scenario starting to play out. Now, history only rhymes. It doesn't repeat itself. So we could always have different changes and different things, but we seem to have very similar situations as we did in the 1920s, where we have massive production capability coming on board, keeping prices low. We have a widening of income gaps that are causing social unrest. Actually, during that time, 1930, Oklahoma, a very red state, was the biggest socialist movement out of all the states, was in that area because the agriculture industry was the biggest contributor to the economy at the time, and most of that was being mechanized. So a lot of those people were losing the farms, etc. So I think there's a lot of correlation to the Roaring '20s and possibly the 1930 Depression that is applicable to today's environment.
Well, I think that the lesson there for right now, from a financial planning standpoint, is that you need to be in assets, risk assets that are going to be increasing during this time. I mean, this is a time in our lifetime that we should be invested in the market where we're going to see asset prices increasing. But there will come a time when we're going to have some type of switch in how we're organizing our personal assets.
Yes.
And that's why those are the types of things we'll be talking about in all of these future commentaries as they unfold.
Yes.
So I think that we're out of time today. I think all this has been very, very interesting. But what final thoughts do you have for the audience?
Well, John, one thing is, and I can share this screen so that the viewers can see it, is how can people subscribe? How can they talk to lead advisors? Are we able to see this on screen? So how would you, if you have questions, whether you want to talk to your lead advisor about the Cash Hub, or you're a new listener and you want to talk to somebody about these concepts, how would they get a hold of people?
Well, they can either reach us by going through our website. We have a contact spot there. They could also reach us at our main office number, which is 314-924-5100, or they can email us. And it would be john.gatewood@gatewoodwealth.com, aaron.tuttle@gatewoodwealth.com, and we'll direct you to one of our lead advisors here.
Absolutely.
But one of the reasons why it's important to have all of you in our audience subscribe and have others subscribe, because this will give us a better ability to spread the word that we're trying to do here, is to give clients and friends a good, true view of the market and the economy.
Right.
Because I think that we look at things in a true, vetted way based upon facts and data, not based just upon opinions.
Yep. And then all of these videos are posted on YouTube. Please go out and subscribe on YouTube. Having more subscribers give us more options on making it easier to deliver these market updates, where we can do better YouTube live versions. And it also is a way to share some of the videos, as well as go back and look at the videos. Test us, see how well we've done. Going back, we started in, I think, March, and we can watch those videos and see what were they talking about March. How did those statements, or how did things unfold relative to what they would see at that time?
Well, the other thing is that the reason why we want as many subscribers as possible is because we truly are on a mission. And our mission is to help families become and remain financially self-reliant. And we truly believe that we're going to have an economic calamity sometime in the next decade.
Yes.
And we want to have as many people as possible prepared so they can not just become self-reliant financially, but also remain it.
Well, that and the opportunity will be there, and you don't have to be concerned or fearful if you're aware and know how to start positioning your portfolios. I don't think a buy and hold strategy is going to be the best strategy over the next decade, but I think there's a lot of wealth that can be made, and there's a lot of wealth that can be maintained. And having those great people that are clients helping and driving the economy in the right way through investment portfolios, I think is going to help society as well.
Absolutely. So I want to thank our audience again for listening in today. And as a reminder, any commentary on an individual stock or bond or mutual fund, any type of security, is not an endorsement to buy or sell. And of course, anything about performance, past performance, is not indicative of future results. So we want to thank you again for listening in, and we look forward to having you back with us next week. So long for now.